a special edition webinar presented by Fairmount Partners. As you all know, PACT is known for our connectivity in the community across a host of channels, including customer relationships, talent, and maybe most importantly for this conversation, capital. And today we're going to talk about capital, and particularly on the subject of valuation. I'm really excited to welcome and present Fairmount Partners, and specifically one of their co-founders, and also by chance, a co-founder of PACT. Charles Robbins is a board member emeritus of PACT, has served this community and beyond for many, many years as an entrepreneur, as a professional advisor, as a business leader in several different roles. He is joined today by Alan Bourne, current PACT board member, as well as principal at Fairmount Partners. Together, they and their partners have advised close to 250 transactions globally in 20 different countries, including a record-breaking year just this past year in 2020 in the middle of a pandemic. Their finger is on the pulse of valuations and deals, and we're excited to have them here this afternoon, to talk about deal valuation. So let me welcome Charles and Alan.
Thanks, Gene. Appreciate it. And hi, everyone. Really appreciate you joining us today. So before we get started, just some housekeeping items. So first of all the attendees are muted. And then secondly, if you have questions, feel free to submit them through the Q&A window in your browser, and we'll try to answer some questions along the way, but we'll reserve some time at the end as well. Okay, so let's get to it. Just to start off, I think as we've all seen, valuations lately, and SaaS valuations in particular, they've been on an epic run. And we get asked by business owners all the time, do you think I could obtain that type of a multiple for my company in a financing or a sale? And the answer is, well, maybe. It depends on whether your business has the right characteristics. And once you understand those characteristics, you can begin to move your business up the valuation chain. And that's what we're here to talk about today. But first, it's my pleasure to welcome my partner, Charles Robbins. As Dean mentioned, Charles has been he's one of the founders of Fairmount. He's got more than 40 years of experience as an entrepreneur, as an executive, as a consultant and an investment banker. He serves as chairman of Ben Franklin and was a co-founder of PACT. And he has also closed a ton of deals. And he has also developed the methodology that we're going to be talking about today. And I'm Alan Bourne. I have over 20 years of investment banking experience in technology, and I lead the software practice here at Fairmount. And just Dean did a good introduction of Fairmount, but a little bit about us. So we're an independent technology-focused investment bank with a long history of serving emerging growth technology companies. Our founders have been entrepreneurs, and we've got decades of M&A experience. And it's that experience that led us to develop the methodologies and processes focused on optimizing positioning and optimizing valuation, which again is why we're here today. So Charles, let me kick it to you to talk a little bit about P5M and how it evolved.
Okay. And let me start by, first of all, thank you, Alan, and thank you, Dean, for the kind words. Thank you to all of you for attending today. We'll try to cover this in around 40 minutes between me and Alan. It will, to go as deep as it's useful to go, could take more time than that. And you'll see at the end, we are happy to provide additional information, or if there's any of you who want to dig in deeper, reach out to us. We do it all the time. As Dean mentioned, we've closed a large number of deals. We had a record year last year. We've been growing, and what Fairmount is known for is our ability to work with emerging growth companies to generate value. Sometimes that's positioning them to get a premium. Sometimes it's working with them to do the right things to develop the business to be able to successfully sell or get a premium. And to us, it's one continuum. I think it's useful if I go back to quickly to a history first. So we're going to tell you why it works and how it works in a little bit. But I'd also like to tell you where it comes from and how it developed to this point, because I think it'll give you some perspective on why it does work. So starting with my background, I literally grew up with the technology and software industry. Starting in the mid-70s, I was a PhD in computer science and mathematics. Computer science was a brand new field there, and that put me in a position to do some pretty interesting things. I was part of SEI before it went public, and SMS right after it went public. I started businesses that ran on, in those days, mainframes and mini computers, and then ultimately started a company, Rabbit Software, that was the first to do what was called client-server computing on these new things called mini computers, which are today PCs, and networks when it was all brand new in the early 80s. Took it public, ended up working with Safeguard. Through the work with Safeguard, worked a lot with emerging growth companies and other VCs in the region and around the country, because again, there was sparse talent in those days. So got to see which companies were the winners, which ones were the losers, which ones got funded. And also I should note that in building Rabbit, I raised 30 million under my own name with my partner to fund it when 30 million was still real money in the 80s. So you can scale that up with a zero and maybe on it if you want. Went on to do other turnaround work and investment work, and ultimately PMG Capital, almost 30 years ago, when it formed out of a group of high net worth people out of Kidder Peabody, they were ready to become a full-scale investment bank, joined up with them. And here's the key there: spent a lot of time working, first researching companies as a stock analyst, then I ran research, then I ran tech iBanking. And it was there that, based on the dozens and then hundreds of companies that would come through our hallways, that being a bit of a mathematician, I started, in effect, reverse engineering, because we were constantly having to advise companies: are you ready to go public? Are you not? Can you raise money? Can you not? What's the value of your business? How do you grow it? And based on all of this back and forth, it became clear there was real value that others weren't delivering. By the way, we grew that company to be one of the top 3 in the world at lower middle market tech public offerings in its era, and also developed M&A. Then ended up we sold it to Investec, a large bank, and Neil McCarthy and I ran the US and Israel, and got perspective from there. And that then led to Fairmount 16 years ago. And you heard the background there. We've closed $12 billion of transactions in 20 countries. So the point is this: literally across thousands of companies at this point, we've seen the patterns of success. We have learned what VCs or PEs, venture capitalists, private equity players, hedge funds look for in investments. So what's the returns they're looking for? What's the excitement they're looking for? What drives the value in the sale? And as we figured this out, reverse engineered it, applied it, we continued to refine it over almost a decade or more. And finally, we realized we'd cracked the code in what drives value in these kinds of businesses. And since then, we've applied it to strategic planning, strategic alignment, executive positioning, execution positioning. So in terms of use cases, we have literally worked with pure strategic analysis. I used to call it McKinsey meets Wall Street, but it seems like McKinsey these days is getting a little bit tarnished. So maybe it's Bain meets Wall Street now. I don't know. But the idea is working with a company a couple of years before they're ready to transact. The time to divert a river is when it's a stream, I often say. We can make an enormous difference in figuring out how to optimally grow a business so it'll get a premium. It's also, the second point there, we have worked with companies on determining what to fund and whether to fund, what to do with divisions, whether to fund them, when to make certain strategic decisions. This methodology and the modeling and the work that goes underneath it, as you will see when Alan takes you through it, is very, very good at delineating what should occur and when and under what circumstances. And the third point, we have worked literally with management teams, with boards of directors, with activist investors in public companies where there was a real disagreement with the management. This methodology puts things on a common ground and allows people to reach common decisions, even when they think they couldn't. Once they start agreeing on a methodology, agreeing on the assumptions, agreeing on the process and the studies, and then when the answers come out of it, and they're all very rational and logical and follow what we call a logic chain, it's easy to make decisions. And then lastly on this list, we apply this in every client we work with. So we have a track record of getting very substantial premium valuations for emerging growth companies. And just to put a point on that, it's because when you're selling a growth business, typically in software in particular, many investment banks, let's say it that way, would tend to position things as they are right now. And sure, they'll talk about upside, but that's how they position it. What this tends to do and what we tend to do is focus on where can the assets of this business lead? How can you grow a much bigger business? Where are the leverage points and where are the proof points? And it all comes out of this work. And our experience is, we say you work twice as hard to get a 30% better outcome, but sometimes we get a much better outcome by doing that. So as you can see in the takeaway box, it's useful both in positioning, it's useful in optics, but also important in operational development. Okay, so that's the background. Now, what I'll do is quickly, and this is the last slide I'll talk to, and then Alan will take it, cover the key elements of P5M from a top-down perspective. So you can see what the P is, and you can see what the 5 M's are. So let's go top-down. And the way to think of it is take the first 3 as being the key, and then the next 3 come behind it. So positioning, mode, market. Start with positioning. Each of these things, by the way, has several sub-elements under it. In some cases, underneath that, there are additional sub-elements, and Alan will show you a little of that, at least on a high-level basis. But positioning is, it starts with what's the unique opportunity, what's the unique need in the market. So we tend to look for what's the white space, what is your company capable of doing based on its core competencies, its assets, its IP, its products, that nobody has done before? What has changed in technology or regulations or demographics that makes it possible to do something that nobody's done before? And why is that meaningful to a particular potential set of buyers? So what's the benefit to them? So that's the need, that's the opportunity. The opportunity then leads to use cases and buyer archetypes. So who are the people who would benefit? For who would it be on a top 3 list? Because if something isn't on a top 3 list, nobody will buy it. It'll be a nice to have and not a need to have. And once you have defined that, you can also define what's the value proposition. So what does this mean? If you're addressing something new that hasn't been doable before, it doesn't mean, by the way, there might not be a prior generation that attacked the problem. It could be a new generation of a solution, or it could be a new solution. But in either event, by attacking this differently, what is the benefit to these particular buyer archetypes or personas? And that lets you define the pricing that you can charge for it. So there's a logic chain here. There's studies under it. Alan will talk more about it. Next is mode. Mode is 2 elements. Where are you today? And where are you going to be in 3 to 5 years? So the today part is, and not that every company is there, but ideally, what would put you 2 years or more ahead of any competitor in this newly defined greenfield market opportunity that we talked about? If you can do that, that says that you're in a position to own that market, at least initially. And then the other side of the coin on mode is your product roadmap. What is the ability to continue to drive this solution forward? Are there a lot of needs in the market that you can continue to fill? Can you put dozens or hundreds of staff years to work? If you don't have the ability to drive a forward roadmap, then you're at risk of commoditizing or marginalizing. And when people look to invest or buy businesses, they're looking at a forward picture of the world, so they need to know that there's a way to defend against that. Market is the key to this whole thing. So let's go back, positioning. I have something unique. Nobody's done it before. There's a reason to believe I could do it. There are buyers that would be clear targets where I could build the scalability model around it. And there's a pricing, a moat. I'm 2 years ahead and I can stay there indefinitely. Now, when I talk about market, people talk about total addressable market. Usually they talk about what we call top-down addressable market. We tend to think, and that's fine, top-down is good. You're in a big market, it's growing fast, industry analysts, all that. We believe in bottom-up TAM, which is you go back to the use cases, the buyer personas, the pricing, the customer journey and value, and you do the math to figure out what the market opportunity is. And going back to what we said before, if you're unique and you can stay there and you can define a market, and here's the key, if that market looks like it's in the hundreds of millions or higher, that's what we call an uncapped market opportunity, because common sense will tell almost anybody that if you're unique and it's new and you've defined it bottom up in that fashion, then today the market is virtually zero because it's new. But in the long run, you should be able to own or continue to own at least 10 or 15% of the market. And maybe a bigger company, if you became part of it, maybe as much as 30%. There'll be competitors that come in, but that's a reasonable thing to make an assumption on. And that means you can grow a $50 to $100 million revenue stream. And as Alan will show you, you build a $50 or $100 million revenue stream in an uncapped market, you've built something that could be worth 500 million or more. And that's a reason to get excited early on in your life cycle. I'll go really fast over these last three and give it to Alan. Momentum are proof points that you actually can, that these buyers, these use cases actually work, that you have what we call a minimally viable product, an MVP, that somebody will buy, that you've got the basis to begin to scale a business. There is a disproportionate tendency to discount potential against momentum. It's said the other way around. If you can show momentum indicators, you get way, way ahead, whether that's revenue growth, growth in funnel, key customers, et cetera. Management almost speaks for itself, but I just want to make the point it includes both your internal team and your external team, especially in financing. People want to know that you can avoid landmines and navigate waters and do pivots, et cetera, et cetera. But credibility goes up dramatically with the strength of your internal team and your external team. And then models, I will, Alan, not spend a lot of time on it now, but and you can touch on it more, we spend a lot of time on what we call spectral modeling and investment case modeling, which is a mechanism to pressure test and show models to the outside world that they will rely upon, because they're going to create their own models anyway, and that support a premium valuation. So with that, because of the limited time, Alan, I'll just hand the floor to you and you can take it.
Thanks, Charles. Appreciate it. So before we get into some of the specific analyses that Charles referenced, let's talk a little bit about what a premium company looks like. So at Fairmount, we track 100 public SaaS companies, and of those, 22 are Rule of 40, which means that the combination of EBITDA margin and growth rate equals 40%. And Rule of 40 companies typically trade at a premium relative to a non-Rule of 40 company. So we tracked 100 of these companies, and historically, we've talked about, and you can see it right here, sort of 10x is a pretty good number. But at the end of the year, back to the point I was making earlier, valuations have just gone absolutely berserk. So at the end of the year, we were looking at median SaaS companies trading at 13.5 times. So the entire universe of SaaS companies trading at 13.5 times, and Rule of 40 companies were trading at 20 times. Today, median SaaS companies are trading, or the universe of SaaS companies are trading at 20 times, and rule of 40 companies are trading at 30 times. So, what does that tell you? Well, I think a couple things. So first of all, we're probably in a bubble. And second of all, it's a good time to be a seller. So sorry. So a good time to be a seller. So, okay, now turning to the M&A markets, we track SaaS multiples by quartile, right? First quartile, second quartile, third quartile, fourth quartile. And the reason that we do that is so that we can analyze each deal within each quartile to determine what drove that transaction's multiple so that we can apply those learnings to our clients. So as you can see, the third and fourth quartile companies traded at a median of 5.6 times for third quartile and 9.3 times for fourth quartile for the second half of the year. But again, those are median numbers within the quartile. The top quartile traded, so the companies within the top quartiles traded for between 7 and 13 times for the second half of the year. But there's examples of even bigger multiples than that. So Divi Cloud sold to Rapid7 for 23 times. Our good friends at Analytical Graphics sold to Ansys for a big number. So what's driving those types of multiples? Well, things like moving to the cloud and security. So that would apply to Divi Cloud, that would apply to the ShopKeep deal, and moving into new rapidly growing sectors that significantly increase your TAM. That would apply to an Analytical Graphics. So that brings us back to the P5M. So in conducting our analysis, we do a bunch of studies for each element of the P5M, and Charles referenced this a little bit earlier. So, and I don't want to go through, I don't want to repeat what he said, but for positioning, what we're trying to show here is what makes this company unique and positioned to dominate in an emerging sector. And how do we determine that? Well, we look at the core competencies. We look at the competitive universe, right? We look at who are the buyer archetypes and personas, and is this a top three pain point? And the idea is to conduct these analyses, and we do it for each component of the P5M, to conduct these analyses to determine, and to position our company such that it's consistent with companies that achieve a premium valuation. So that's positioning. For moat, we want a company with a strong current competitive barrier and a roadmap that will maintain those barriers for the foreseeable future. So we're examining things like, what are the competitive barriers? What is the IP? How many staff years went to develop it? Is the product sticky? Is there a market and differentiation strategy, right? So by analyzing all of these things, we can determine what is the moat of the business. The market we've talked about. Charles mentioned that we do a bottom-up TAM, but ideally, what we're hoping for, and particularly for growth stage companies, is there a unique market that can support a revenue opportunity of $50 to $100 million or more, right? And if it can, then that's something that buyers are going to look for. So we talked about bottom-up TAM and top-down TAM. These, and again, we do a market SWOT, so we're diving in on each and every one of these things. On momentum, Charles mentioned this. We look at the funnel. We look at the funnel stage gate. Do we have a company with a basis for a scalability model that can support its market opportunity? And then on management, do we have a management team that can steer the ship and scale and avoid potential business pitfalls? And I think one thing that, particularly companies who are early stage, who are seeking venture capital, VCs are backing management teams, right? Is this the guy that can lead this company on a growth trajectory? Is this the team that can lead the company on the growth trajectory? And part of our analysis isn't just that, how good's the team, but what does the management structure need to look like as this company grows? Do you have a chief revenue officer? right? Do you have the infrastructure underneath that can help the business grow? So that's what we're doing when we're looking at the management team. And then a model. Charles talked about spectral model, the spectral model analysis that we do. Again, we do four versions of the model. So it's base case, plan case, gross case, and investment case. Base case is sort of the CFO's version of the model. Growth case is the CEO's version of the model. Plan case is somewhere in between. And then we do with the investment case model, because the investment case model shows what synergistic, what synergy opportunities might be available with a potential buyer, right? So what happens if we leverage a much bigger sales and marketing infrastructure? What happens if we leverage a bigger customer base? What are our cross-selling opportunities, right? And so the investment case gives us a pretty good idea for what those opportunities look like. So those are the P and the 5 M's. So how do we apply it, right? Well, we do all these analyses and we put them together from a valuation perspective. And it's important to understand that there are 3 primary uses of a valuation analysis when we list them out here. So first of all, first of all, we want to calibrate where do we think likely buyer initial, what do we think the likely buyer initial valuation position will be? That means that when buyers apply standard industry median multiples, where do we think they'll come out from a valuation perspective, right? So understanding that. Triangulating the potential value outcomes and the probabilities of those outcomes is another use of valuation analyses. And then the last one is positioning your client to optimize negotiations. And we'll talk a little bit about this in a bit, but the idea is that when we're talking to buyers, it's, hey, our company is more like company X that got a big, huge multiple than a median company. And by using the P5M, we can hopefully explain why. Okay, so knowing all this, we typically conduct 3 distinct valuation analyses when we're working with our clients and with our partners. And so they define baseline valuation, sweet spot, which is what we believe to be the central probability, and premium valuation, which becomes untethered from market multiples. So, and one more thing to add before we move on, it's important to remember that when companies are paying a multiple for a business, despite the fact that multiples or valuations are typically expressed as a multiple of revenue, the actual valuation is driven by a number of factors, right? And I want to talk about those next. So, so the way that we view the valuation drivers is we view them on a spectrum, right? So it's, are you a true SaaS business, right? True SaaS businesses get a higher valuation because it's recurring revenue. They're sticky. You don't have to go out and find your new customers year after year. That drives a premium. Large, fast-growing companies drive a premium, right? Charles talked about the market sizing, right? Do you have a large market? Is it a rapidly growing market? Do you have what we call an uncapped market opportunity, right? The ability to grow to $50 to $100 million, the ability to get super big, is your opportunity uncapped, right? Those deserve higher multiples. And then also, what are the buyer synergies, right? And then are there other aspects, like unique IP, anything like that, a competitive position, anything like that, which would help convince a buyer to pay more. So moving on, how do we optimize value? So we talked a little bit about this earlier. And as discussed, baseline tells us the point from which we believe buyers are going to negotiate, right? It's going to be based on, it's a mechanical calculation. It's based on size. It's based on stage, mix of revenues, right? And this is their typical starting spot. And it's good to know, because it's, you know, when you're involved in a potential transaction, you want to know where you think the buyers are going to be coming from. Sweet spot is where we think the probabilities are, right? And this is typically going to be based on a more narrow set of potential M&A transactions. We're more like this one than this one, but we get very targeted, and we work very hard to understand the unique characteristics of your business, but also the unique characteristics of transactions that happen in the market, so that we can say, look, they've got the same momentum, they've got the same value prop, they've got a better market, right? So being able to identify specific transactions that are much more like us than the median transactions helps understand where the central probabilities are gonna lie.
Yeah, and Alan, just to add to that, what our job is, and you'll see this in a slide or two, is to move from the left all the way to the right. So by hand picking the things that are more like us and understanding where they start, we can then move them towards, so it not only establishes a central probability in terms of evaluating the likely outcome, but it changes the nature of the dialogue. You know, you start talking about more of a third and fourth quartile thing and not a median thing. Anyway.
Yeah, thanks, Charles. And then the premium valuation, again, can we get credit for synergy value? Can we get credit for future potential value of the business, right? The idea is if you've got a business that's at $5 million in ARR today, but everything is in place to grow this business to $40 million, right? How do you get credit for part of that, right? You'll never get credit for all of it, but the idea is that if there's synergy value, buyers are going to be looking at that. Buyers are going to be making decisions on that. And, you know, our goal is to try and drive conversations to that, drive conversations to synergy value, as opposed to any sort of value that's based on multiples.
And Alan, again, if I could just say a word or two there. So when you see premium valuations and you see that somebody paid, we've had deals that went off, well, the Ansys one was 9x, but we've had deals in the teens fairly recently. They're not paying in the teens of revenue. They're buying the fact that they're getting a unique position in a major emerging market with a large TAM and a lot of synergies on top of it. They're doing their own internal model that says this thing's worth a ton to us, because not only does it allow us to drive a lot of revenue in this new market and cross-sell, but maybe even change the competitive universe or the optics in the market. And that's worth a lot more than any multiple you'd put on your current or even future metrics. When we've gotten the real premiums and the super premiums because we were successful at doing that. Now we'll talk about a little more about that kind of thing.
Yep. Okay. So how do we get a premium valuation? Well, so we've talked about the valuation contributors that come through P5M, right? It's positioning, market moat, things like that, right? Those, and being able to position yourself like a premium company, like a company that transacted at a premium valuation, are going to help drive you into the premium category, right? Market conditions are things like SaaS companies are trading at 30 times, and external valuation metrics, right? But the thing at the top that's really important is perfect preparation and perfect process, right? And this is where your investment banker comes in, right? It's important to start, so from a preparation perspective, it's important to start reviewing these factors early, And that's and by doing that, as Charles mentioned earlier, it's a lot easier to divert a river than it is to divert a stream. And we've done these types
It's
of.
actually the other way, but yes.
Yes, it is. It's the other way. Sorry about that. I always talk about bridge over the water, or water over the bridge as well. So, but the point being is that if you're thinking about these things now, you can affect real change on your business today, so that you don't have to think about these things when you're just about ready to go to market, or you're just about ready to get liquidity, right? And then perfect process is the other thing, which is having a quality investment bank that can run a really good, tight process that goes above and beyond to understand how you are unique and specifically how you are, and be able to communicate that to potential buyers, be able to communicate to potential buyers why exactly you are the perfect fit for that potential buyer.
Yeah, and Alan, again, forgive me if I jump in again. This isn't a sales pitch for an investment for us or any investment bank. The point here is, if you want to get the premium, nobody's going to give it to you lightly. They'll see the synergies, they'll model it. If we do a good job in the prep side and the synergy side and how we present it, but it's critical to generate a sense of competition and alternatives. And if you do a very, very good job of how you present the level of your sophistication, and they view that you've got a lot of optionality, that is what can create a real value. So in the key to the top of the pyramid is getting the preparation right, getting enough people interested, and then running a process that creates a perception of severe competition. And again, when you see the ones that are premiums, that's usually what's going on in the background.
Thanks, Charles. So to summarize, how do I get 10 times? So using P5M, we can deconstruct a business and figure out how to drive it up the valuation pyramid. And it can be done at the point of a transaction. But as we've talked about, it's much more effective when you start early. And lastly, beyond careful positioning, perfect prep and perfect process are key.
Yeah, and I'd like to put a point on this. We prefer, most investment banks prefer to work with companies at the point or near the point of a transaction. We're very happy to do that. We get paid to do that. That's great. We are at least as happy and maybe happier if a company comes to us 2 years or more with real potential, and we can work with them to help do these things and bake it in, because it can the learnings from this process to your operation, you apply them over the course of a year to 2 years, and you end up in a different place, in a better place. They're useful to position at any moment in time, but they're incredibly leverageable if you get involved earlier. So unlike a lot of other groups, and this is the joke I make about McKinsey meets Wall Street, or today I call it Bain meets Wall Street because McKinsey's got tarnished, is we're very happy to work with companies, and we do it all the time to offer them assistance and advice long before there's a transaction process. And, we do that to help companies along, but it results in good outcomes, and it's a win for everybody.
Great. So how do you get started? Well, so if you're interested in learning more, we do offer detailed information that's available upon request. So Sam asked, are the slides available? Yes, Sam, we'd be happy to make the slides available. Well, we've got additional information on P5M. We've got a quarterly SaaS report that talks about the drivers and metrics related to the SaaS markets. And then we've got other reports that are based on and provide good information on specific technology verticals. So we've got a life sciences monitor, which is life sciences software. We've got an HR tech report, and we're happy to make those available as well. And if anybody is interested in applying the methodologies today, feel free to reach out, and we'd be happy to help get you started.
Yeah, and just in fairness to the other units at Fairmount, there's also reports on consulting and technical services, life sciences. We've got a number of others, and we're always happy to provide it. Look, we've been very involved in this region for a long time. We care about people here and elsewhere. We're very, very interested in emerging growth companies. That's a passion that was, I mean, certainly my background, where I came out of it. So if we can help people, I say it all the time, an hour of our time can really make a difference, and iteratively we can do that over and over and help people along. And sure, if there's something more concrete that comes out of it, we can go even deeper, but we're here to help.
Absolutely. So thank you. Our email addresses are here. And like I said, we're happy to make the information available. And I will note that there is a Remo platform that is going to be opening up for networking after this. And you got to hop off the Zoom and hop onto the Remo. And I think Dean or Danielle, one of them will post that into the chat window. But I will be there, and I'm happy to chat with anybody and continue the conversation and answer any questions that I can. Right after I get a drink of water.
Alan, do you want to take a question or two that are popping up in the chat?
Happy.
Yeah. I will not be on the Remo platform. So if you have any questions, for example, that I'm going to answer, we should do them here, and then you guys can all go to the Remo platform after.
Thanks, Dean. Yep.
Yeah. So the first question comes from Brian. Of the P5M, which do you see as the hardest to change through the Wall Street meets Bain engagements? Which ones are easier to make progress?
It's a good question. Look, the first three are the key. And the key of the three, if you really want to look at it that way, and it's a great question because you want to center on something, is the TAM, the unique TAM, bottom up. It really incorporates all three, right? But if you've got something unique and you've got some decent barriers, and you think there are buyers that would really want to buy it, then the question comes down to, is it big enough to support the kind of valuation? So for example, we have a current client who is just going to market right now. They came to us 2 years ago. They had 10 million of revenue. It's in this one's in the healthcare technology sector. And when you did a TAM analysis, they were very strong. They were dominant in what they did, but it looked like a $150, $200 million TAM. So here's the thing. Instinctively that they could grow a 20 or 30 million business, but could they grow a 50 or 100 million or more business? Not so obvious. You take some business like that to market, and what experience teaches us, and sometimes we do better than this, but you have an uphill battle to get the kind of premium we want. So we worked with the company and defined all we do is catalyze. We said, okay, do we agree it's this size? How do we get it to be that size? And we got some outside people that we know are good at this and brought them in. And, we worked well. Anyway, a year later, they had a roadmap that would open up $1 billion TAM. But not only did that cause them to recognize a TAM, they had some very good customers. They interacted with the customers and had real demand pull, went to work on building the product. The new product's now in beta. They've got companies lining up all over the place. Oh, and by the way, the revenues have now grown to somewhere between 18 and 20 million and 8 million of EBITDA. So that company, which is growing at 50% a year now in an uncapped market, who knows what the outcome will be, but look at the statistics that Alan showed you. There's reasons to imagine, let's just say imagine, that they could be a 10x ARR company worth a couple of $100 million. 2 years ago at 10 million, maybe they would have gotten 40. Who knows, right? But you see the point. I hope that helps. You there?
Yeah, no, that's helpful, Charles.
Any other questions?
No other questions from the chat. If anybody else has any questions, it can certainly do so in the Remo room, and we're going to move there now.
Okay.
with that, let me again thank Charles and Alan for putting this together. Some questions about sharing the slides, and we'll get Charles and Alan's endorsement to do so and share that with the with the group of participants that we've had on. In your chat right now, you see the live link to go move into the Remo room. This is ideally done through your Chrome browser. That's the best one to utilize. And look forward to seeing you at some tables there for some networking. But again, Charles, Allen, really appreciate you sharing your insights and inside wisdom on how to push valuation on deals. And congratulations again on all the success you've had in doing so.
Thanks, Gene.
Thank you.
All right.
All
Look
right.
forward to seeing everybody.
Thanks, everybody.
Look forward to seeing everybody in the Remo room.